welcome back to Bonnie's Life, your home for deep, intellectual, and actionable insights into the world of finance and cryptocurrency. I'm your host, Bonnie. The markets are a sea of red, and fear is palpable. Bitcoin has plunged below the critical $90,000 mark, and a perfect storm of global economic events is rattling even the most seasoned traders. But is this a time to panic or a time to pounce? In today's episode, we're going to cut through the noise. We will conduct a comprehensive, multifaceted analysis of the current crypto market, tailored for three distinct types of traders: the nimble short-term scalper, the patient mid-term swing trader, and the visionary long-term investor. We'll dissect the technicals, scrutinize the fundamentals, and map out the global events shaping our financial reality. By the end of this episode, you will have a clearer picture of the market structure and be equipped with concrete strategies to navigate these turbulent waters. Whether you're a beginner just starting your crypto journey or an advanced trader looking for an edge, this analysis is designed for you. Let's get started. Before we dive into the intricate details, let's establish the current state of the crypto universe. As of January 21st, 2026, the global cryptocurrency market capitalization stands at approximately $3.09 trillion. While that number sounds massive, it represents a significant 2.2% contraction in just the last 24 hours, a clear signal of the bearish pressure we're witnessing. The 24-hour trading volume is a robust $149 billion, indicating that there is a great deal of activity and decision-making happening right now. This high volume during a downturn tells us that this is not a quiet bleed. This is active selling, and that means opportunities for those who know how to read the market. Bitcoin's dominance has crept up to 57.5%, a phenomenon we often see in times of uncertainty as capital flows from more speculative altcoins into the relative safety of Bitcoin. Think of it as a flight to quality within the crypto ecosystem. When the seas get rough, traders seek the largest, most liquid ship. Ethereum's dominance, in contrast, is at 11.6%, reflecting the broader altcoin weakness. Now, let's talk about the elephant in the room. Price. Bitcoin is currently trading at around $88,976, a level that has many traders on edge. It has shed nearly 2% of its value in the last day and over 6% in the past week. Ethereum is facing even stronger headwinds, down over 4% to $2,957. This price action is a direct reflection of the market sentiment, which we can quantify using the Crypto Fear and Greed Index. Right now, the index is flashing a score of 25, firmly in the fear territory. Just yesterday, it was at 32, and a week ago, it was a neutral 48. This sharp decline into fear tells us that investors are worried. But as the legendary investor Warren Buffett once said, it is wise to be fearful when others are greedy, and greedy when others are fearful. The question is this the time to be greedy? To answer that, we need to understand what's driving this fear. The current fear in the market is not irrational. It is a direct response to a confluence of powerful global macroeconomic events that are sending shockwaves through every asset class, not just crypto. First and foremost is the crisis brewing in the Japanese bond market. For years, Japan's ultra-low interest rates have provided a source of cheap capital that has fueled risk assets worldwide, including crypto. This is what we call the yen carry trade. Investors borrow money cheaply in Japan and invest it in higher-yielding assets elsewhere. Now, we are seeing a massive, unexpected sell-off in Japan's $7.6 trillion bond market. Japanese government bond yields have surged at a pace not seen since 2022. United States Treasury Secretary Scott Bessent, speaking at the World Economic Forum in Davos, called it a 6 standard deviation move. For those unfamiliar with statistics, a 6 sigma event is extraordinarily rare. It is a statistical way of saying this is a black swan event, something that should almost never happen. The Nikkei index fell 2.5% and the S&P 500 dropped more than 2% during the US trading session. This turmoil threatens to tighten global liquidity, effectively turning off the money tap that has propped up markets. The Bank of Japan is now caught between a rock and a hard place. Either tighten monetary policy and suck liquidity out of the system or risk a full-blown implosion of their currency and bond market. Neither option is good for risk assets in the short term. Tim Sun, a senior researcher at Hashkey, told Decrypt that the sell-off has clearly exceeded market expectations, evolving into a broad-based shock to global financial markets. Adding fuel to the fire are the renewed threats of tariffs from the Trump administration and escalating trade tensions with Europe. We have seen this movie before, and it always creates volatility. The mere announcement of potential tariffs wiped out $875 million in crypto liquidations in a single 24-hour period. 90% of these forced closures hit long positions, meaning the bulls got absolutely crushed. This geopolitical uncertainty is causing a sell America trade to emerge, with investors fleeing the US dollar, which has seen its largest daily fall in over a month. Compounding this is the recent trend of outflows from the much-celebrated Bitcoin spot ETFs. While the total inflow since their launch is a staggering 619,000 BTC, the last few days have seen consistent outflows adding to the selling pressure. On January 20th alone, we saw a net outflow of over 5,000 BTC from these ETFs. In this environment of fear and uncertainty, it is no surprise that capital is flowing into traditional safe havens. Gold has surged as much as 4% to an intraday record of $4,866 an ounce, a classic flight to safety. When gold is rallying and crypto is falling, it tells us that the market is in risk-off mode. Investors are prioritizing capital preservation over capital appreciation. Understanding this macro backdrop is essential before you make any trading decisions. Now that we understand the macro environment, let's zoom in on the charts and see what they are telling us. We will approach these from 3 different perspectives using different time frames for each trader profile. This is where the rubber meets the road. For those of you who operate on the lower time frames, the short-term traders and scalpers using 1 hour to 4 hour charts, the current market is a scalper's paradise, but also a minefield. Bitcoin is currently locked in a well-defined sideways range between definitive support at $85,600 and key resistance at $94,200. Your primary job is to trade this range until it breaks. The indicators are painting a bearish picture in the short term. The Relative Strength Index, or RSI, on the 4-hour chart is below the neutral 50 mark, suggesting that sellers have the upper hand. The Moving Average Convergence Divergence, or MACD, histogram has also crossed below the zero line, confirming that selling momentum is building. A simple and effective strategy here is to look for short entries near the top of the range, around $94,000, with a stop loss just above the recent highs. Conversely, you can look for long entries near the bottom of the range, around $85,600, with a stop loss just below the recent lows. Pay close attention to open interest and liquidation data from sources like CoinGlass. Currently, total open interest across all exchanges stands at approximately $67 billion. A spike in open interest as we approach the range boundaries can signal a potential breakout. High liquidation levels can also act as magnets for price. For example, if there is a large pool of long liquidations just below the $85,600 support, price may be drawn down to trigger those liquidations before reversing. This is how market makers hunt for liquidity. Your triggers are clear. A rejection from the range highs is a short signal, and a bounce from the range lows is a long signal. Be nimble, take profits at the opposite end of the range, and do not get married to a position. Risk management is everything in this environment. For swing traders using daily to weekly charts, the mid-term traders, the daily and weekly charts provide a clearer signal, filtering out the intraday noise. The most important level to watch is the 50-period simple moving average on the daily chart, which is currently sitting around $90,123. This level is acting as a battlefield for bulls and bears. A sustained close below this level would be a significant bearish signal, opening the door for a test of the range low at $85,600 and potentially even the swing low at $82,096. Conversely, if the bulls can reclaim the 50-period SMA, it would be a sign of strength, and a retest of the range high at $94,200 would be likely. Your strategy should be one of patience. Do not get chopped up inside the range. Wait for a confirmed breakout. A daily close above $94,274 would be a strong bullish signal and a valid long entry for a swing trade targeting the $100,000 psychological level. A daily close below $85,600 would be a strong bearish signal and a valid short entry targeting the $82,000 area. You must also be a macro-aware trader. The upcoming economic data releases are major catalysts. the US GDP data, and most importantly, the core PCE price index, the Fed's preferred inflation gauge, are due this week. A hotter than expected inflation number could send risk assets, including crypto, tumbling. A cooler number could provide the fuel for a breakout to the upside. The FOMC meeting on January 27th and 28th is the main event. While a rate cut is unlikely, with the CME FedWatch tool showing only a 5% chance of a quarter-point cut, the Fed's tone and forward guidance will set the direction for the markets for weeks to come. JP Morgan expects the Fed to remain on hold through 2026, keeping the current Fed funds rate at 3.64%. Position yourself accordingly and consider using options to define your risk around these major events. Options allow you to participate in potential upside while capping your downside, which is invaluable in uncertain times. For the long-term investors, the hodlers using weekly to monthly charts, the current market action is just noise. Your thesis is not based on 4-hour charts or the next FOMC meeting. Your thesis is based on the fundamental value proposition of Bitcoin and decentralized finance. The crisis in the Japanese bond market is not a reason to sell. It is a confirmation of your thesis. It is a real-time demonstration of the fragility of the fiat currency system. When a major central bank is forced to choose between currency debasement and a bond market collapse, the argument for a non-sovereign, inflation-resistant asset like Bitcoin becomes stronger than ever. Look at the weekly chart. The long-term uptrend is still intact. The recent dip is a healthy correction in a larger bull market. Your strategy is simple. Accumulate. Use periods of extreme fear, like the one we are in now, as buying opportunities. Dollar cost averaging, or DCA, is your best friend. By buying a fixed amount of Bitcoin every week or every month, you average out your entry price and reduce the risk of buying the top. Do not try to time the bottom. Nobody can. Instead, focus on consistently accumulating an asset that you believe has a 10x or even 100x potential over the next decade. The recent ETF flows, despite the short-term outflows, are a testament to the growing institutional adoption of Bitcoin. This is a long-term trend that will not be derailed by a few weeks of negative price action. Major institutions are building positions, and they are not selling because of a 6% weekly dip. Have conviction in your thesis, zoom out, and think in years, not days. Remember, Bitcoin has experienced multiple 50% drawdowns in its history and has always recovered to make new all-time highs. This current pullback is minor in the grand scheme of things. So let us crystallize this into actionable strategies for each of you. Your world is the range. Master it. Use tight stop losses, typically 1 to 2% of your position. Take profits when they are there. Watch the liquidation maps and order books like a hawk. Do not be a hero. Be a survivor. The goal is to chip away at the market, collecting small wins that add up over time. Stay informed about the intraday news flow, as a single headline can invalidate your setup in seconds. Consider using leverage cautiously, if at all. In this volatile environment, a 2x or 3x leverage is more than enough. Anything higher is gambling. Your mantra is confirmation is key. Wait for the breakout from the range. Do not front-run it. Let the market prove itself to you. Align your trades with the major economic catalysts. If you are bullish, wait for a cool inflation report and a dovish Fed. If you are bearish, wait for a hot inflation report and a hawkish Fed. Use technical levels like the 50-day SMA to confirm your bias. Your patience will be rewarded. Consider building positions in trenches rather than going all in at once. This allows you to average into a position and reduces the impact of short-term volatility on your entry price. Your strategy is the simplest, yet the hardest to execute because it requires unwavering conviction and emotional discipline. Buy the fear, accumulate consistently, ignore the noise. Understand that volatility is the price you pay for performance. Your time horizon is your greatest edge. While others are panicking, you are calmly stacking sats, knowing that the fundamental reasons you invested in this asset class are not only intact, but are being validated by global events. Consider setting up automatic recurring purchases so you do not have to make emotional decisions during market turmoil. Remove yourself from the daily price action and focus on the long-term trajectory. The crypto market is at a crossroads. A storm of macroeconomic uncertainty is raging, and fear is the prevailing sentiment. But within this storm, there is opportunity. For the short-term trader, it is the opportunity to profit from volatility within the range. For the mid-term trader, it is the opportunity to catch the next major swing once the breakout is confirmed. And for the long-term investor, It is the opportunity to accumulate a potentially world-changing asset at a discount. Whatever your trading style, the key is to have a plan, manage your risk, and execute with discipline. The information we have discussed today should serve as a foundation for your own research and decision-making. Remember, this is not financial advice. It is education. Always do your own research and never invest more than you can afford to lose. What are your thoughts on the market? Are you buying, selling, or waiting on the sidelines? Let me know in the comments below. I read every single comment and love engaging with this community. If you found this analysis valuable, please do me a favor and hit that like button, subscribe to Bonnie's Life, and ring that notification bell so you never miss an episode. Your support helps this channel grow and allows me to continue bringing you this high-quality analysis. Until next time, trade smart, stay informed, and I will see you in the next video.